Okay, today we are going to look at the basis of accounting. So, under basis of accounting, we are going to look at four things here. We have accrual basis, which is known as matching concepts. Then we have cash basis. Then we have breakup basis. Then we have modified cash basis. So these are the things we are going to look at under this our basis of accounting. So ordinarily there are three bases of accounting which we are going to look at, and the three bases are: one, we have the accrual basis, the cash basis, and the breakup basis. This modified cash basis is the combination of these two, but we are going to look at everything as time goes on. So first of all, let's look at what is accrual basis. Accrual basis, as I said, is also known as matching concept. This is a type of accounting which recognizes transactions and other events in the period in which those transactions or events occur, even if the resulting cash receipts and payments occur in another different period. That is accrual basis. So what I'm trying to explain here under accrual basis is that any events or transactions that take place in a particular period is supposed to be recognized in that period, regardless of whether cash is being paid or received in that particular period. Let's assume that transaction happened in 2002, but payment take place in 2003. But this event happened in 2002, but the payment was in 2003. So what this basis is saying is that regardless of when that payment happened, the transactions or the events supposed to be recognized in 2002, not in 2003 where the payments occur. That is what this basis is explaining. So in a situation whereby revenue from sales or other income happen in a particular period, when the income arises, maybe let's say, just like this example, you have to recognize, for instance, you make a sale, that is a revenue, a sales of, let's say, 5,000 in January, but you did not receive this money in January. The sales, that is, the sales took place in January, but you receive payments in February. Payments in February. What will happen here is that this your revenue, you are going to recognize it in January, not in February. So that is what this is saying, and the associated cost to this revenue, it will also be recognized in January, not in February. So that is what this accrual basis is all about. Okay, let's look at a simple illustration. Let's say you have a sales in January, but payment happened in February. So you are going to recognize your revenue in January. Then cost of sales of the same revenue, you are going to do what? You are going to recognize it in the same January. So your difference is what? This is your gross profit in the same month. Then if you have other expenses, you are going to do what? You are going to deduct your other expenses in the same month. So what you have is what? Is your net profit. So this net profit, it doesn't matter whether you have that net cash in that particular period or not, but you just have to recognize it in the same months. That is cash accrual basis. So let's look at a simple illustration here. Simple illustration. Let's assume a company prepared its financial statement on what? 31st of December every year. Let's say company A prepares its financial statement 31st of December every year. So it now sells goods for 50,000 naira. Sells 50,000 naira. So sells 50,000 naira to customer A. So this is customer A. On when? On 30, let's say on the 5th December 2001. So but you did not receive payment. There is no payment in that 2001. You now receive payment on, let's say, 15th January 2002. So let's assume this is the question. So what are you supposed to do? You are using accrual basis. What are you supposed to do with this kind of transactions? The sales is recognized as income in the financial statement of 2001, not in 2002, but you received the payment in 2002. But as far accrual basis is concerned, you have to recognize this in 2001. So that is what we have under accrual basis. And now let's look at the second one, which is the cash basis. So cash basis recognize transactions in the period in which cash receipts or payments happens. What this means is that the period whereby you make payments or you receive cash, that is when you are expected to recognize your transaction, not when that transaction take place. So that is what this means. Okay, let's look at a simple example here. Okay, let's use the same example here. So this like a company A sells prepares financial statement on 31st of December every year, so and sells goods amounted to 50,000 naira to customer E on 5th of December 2001, but did not receive payment until 15th of January 2002. What are we supposed to do under cash basis? Because so now we are not going to recognize our revenue in 2001. we are going to recognize it in 2002. That is the only difference. Here we recognize when we actually received the